Hi everyone, I'm Yonglin Xu, and I'm gonna talking about the changes in the term structure by using the operation twist from the Fed. So those are my contents. I'm gonna talking about the introduction, the theory explanation, the case analysis, and the future thinkings of the operation twist from the Fed. And firstly, this is my introduction, and I split it into two parts. Firstly is the theory introduction, and secondly is the case introduction. So for the first part, the basic theory that we're going to use in this study is the term structure, which I said in the topic. And this theory is basically showing the relationship between the yields of funds with different maturities and the maturity period at the time point. The term structure of interest rates shows that the demand and supply relationship of funds in different maturities and reveals the overall level and direction of changes in market interest rates, which are providing references basis to the investors to engage the bond investments and the relevant department of the government to manage the bonds. So for the perspective of correspondence, since the yields of maturity of the zero coupon bonds is equal to the spot interest rate of the same maturity. The term structure at any time will be the function of the interest rate level and maturity. Therefore, the term structure of the relationship between the yield to maturity of the zero coupon bonds and its maturity can be represented by a curve, such as the downward sloping curve and upper sloping curve and horizontal line, which can be shown on the right side of this PowerPoint. And this graph is like by myself, so it's not that accurate, I think. So for more complex yield curve, it is also possible to exist that the combine of those three kind of bond yield curve. So or even all of them were showed in the one graph. So and the changes in the yield curve basically reflect the relationship between the maturity yield of the bond and its maturity, and which can also be said that the difference of the interest rate performance of a bond in short term and long term. So that's the term introduction. And then it's the case introduction, which the basic research case will gonna be the term structure operation test from the Federal Reserve starting from 2008. So since 2008, the United States implied two rounds of quantitative easing. The first round is from October 2008 to June 2010, which is the Fed purchased approximately 1.725 trillion US dollars in the government bonds, mortgage-backed security, and other assets. The following round was starting from August 2010 to June 2011, when the Fed purchased 0.6 trillion US dollars of long-term government bonds. And on the 21st of September in 2011, the Fed announced that in order to further stimulate economic recovery, it planned to launch a 400 billion US dollar operation twist until June 2012. The operation twist means that to sell the short-term government bonds and to buy the long-term government bonds, and to extend the overall maturity of the government bonds assets without expanding the size of balance sheet of the government or of the country. So looking for the perspective of the yield curve, this kind of operation is equivalent to bending the far end of curve downward. So it is why the operation twist named. So this is basically the introduction of the two main parts. And then is the theory explanation. So this theory can be divided into three small theories. So I'm gonna explain it one by one. So the first one is called the expectation theory, which just means that the shape of the yield curve is determined by the future short-term interest rate that the market expected, and it's worth to be said that they have to give some assumption in the beforehand, so the market need to be complete and efficient. The funds need to be freely flowed. There's no transaction cost and taxes. There's no fault risk, and it can be substitution between bonds and have other maturities. And the expectation of future short-term interest rate level from the investor are consistent and unchanged. And the aim of investor is to maximize the profit. So those are the assumptions that need to be made forward before we're talking about this theory. So as we can see, an upward yield curve indicate that the market expects short-term interest rate to rise in the future with forward rates exceed spot rate. And a downward yield curve indicate that the market expects short-term interest rate to fall in the future, and so it's like the opposite to the first one I said. And for the horizontal yield curve, they indicate that the market expects short-term interest rate to remain roughly unchanged, and the forward interest rate is equal to the spot interest rate. So this is basically the first theory, and then the second one is the liquidity preference theory. So for this theory, they also have some assumptions beforehand, which are like the investors are risk averse, expectation and risk can be all affected by the term structure, and the liquidity of short-term bonds is higher than the long-term bonds. So this theory told us that the investors are aiming to reduce the risk by select more short-term bonds with strong liquidity, while for those long-term bonds are less liquidity. Investors require a certain liquidity premium as the compensation for the opportunity cost and risks. Therefore, the normal and more common yield curve can be considered as an upward sloping yield curve. So, and there are the third, which is the last theory of this term structure theory. And they also have assumptions beforehand, which are firstly, the bond market of different maturities are separately and rarely affected by the bond market of each other, like the different maturities. And secondly, the investors from different investment needs formed in the market. And thirdly, all investors are rational. And lastly, the different investors have different preferences for the bonds of different maturities. So based on those assumptions, we can tell that the market of bond is divided into three parts, which are short-term, medium term, and long term. So each of these markets are relevantly segmented. Um, so, and they are rarely affected by each others. So the supply and demand force of each market should be determined by the spot interest rate of bond in that market. And so this is how this small theory be named, which is called the market segmentation theory. And to have a little like example on this, the short-term interest rate will be determined by the relationship of supply and demand in short-term bond market, but not others. So they are like separated. So those are like all my theory explanation in this part. And then next one is the case analysis, which the aim of this case, like the aim of this this case or this statement is that the Fed conduct operation twist with the intention to changing the term structure, and the usual bond yield curve growth with maturity convexity means that as maturity increases, the growth rate of the term premium will be decreased, and expectation of people about the short-term interest rate and their uncertainty in the long-term future will be stabilized. However, after the Fed implemented 2 times of quantitative easing, although long-term interest rate falls, short-term interest rate falls more significantly. It caused the yield curve of U.S. government bond to become concave upward. And this caused the U.S. dollar to become the source currency of carry trade funds, which means that to borrow U.S. dollar with the zero or even or like lower or zero interest rates and exchange them to currencies which have higher interest rates in other countries, like the currency of other countries, like and larger interest rate differentials can lead to gain from interest appreciation, and this will lead to larger outflows to the short-term U.S. dollar funds, and this will affect the economic recovery. And then, so the Fed plans to sell 400 billion U.S. dollar of short-term and medium-term government bonds with remaining maturities of 3 years or less by June 2012, while purchasing the same amount of medium-term and long-term government bonds with remaining maturity of 6 to 30 years. So the result of this is that to adjust the term structure of this case, we should reduce the expectation from people for the for future short-term interest rate and their uncertainties. Increase short-term interest rates in the money market and encourage society to engage in relatively stable medium-term and long-term refinancing. This will promote stable expectations from people for the future economic situation and is conducive to economic recovery. And based on this case, I had some like further thinkings about it. which is that we have to say that first the investors are paying close attention on the flattening of the yield curve, like since it is a good indicator on economic slowdown. However, sometimes we do not need to fully follow the traditional like statement in this financial crisis and financial recoveries. So for the Fed, they have like leading the central bank's policy to respond this crisis and significantly decrease the interest rate, quantitative easing, and operation twist are all actions that Fed announced, which they simultaneously sell short-term bonds and buying long-term bonds to help reduce the cost of borrowing and boost the economic growth. So they successfully diminishing the unemployment rate to a lower level, and the capacity limits are already or like will be about to reached, so that the quantitative easing need to be canceled, no matter if it is conventional or unconventional. Like the central banks firstly decide to reserve the traditional quantitative easing and restore the short-term interest rate to the normal level before the financial crisis. The Fed can, like the Fed is already we can see succeed in this level, so that like I think they should change their focus from the convention rate to the unconventional measures that they announced or they took. So which we can have one example is that the Fed used a series of gradual rate hikes to cool down, which is like the economy. The cause of this is they increased the short-term interest rate and lead to a flattening yields curve. So we can see from the graph on the right side. And but there's more considerations that the next step of this policy is to like less depending on the increase of interest rates. So it will aggressively unwind the quantitative easing and reverse the operation twist. So as I said before, the market pays highly concerned on the flatness of the curve and its effect. But not only the market concerned it, also the Fed is concerning about it. So that people believes that the Fed should strengthen the policy and sustain the growth. Meanwhile, to cancel the stimulus measurements they took to unconventional policy in order to decrease the risk on balance sheet. So those are what I thought about, and which I don't know if it's correct, but for this presentation, this is the last part, and we can see that the operation twist is the first announced by the Fed in like very early time, that it is aimed to restore the yield curve. And so I think people should or people may have the expectation that the Fed can that the Fed can reach the better operation and achieve important goals to minimize the unemployment rate, price stability, and moderate long-term interest rate. And so that's all about my presentation. So thank you for your watching.